Hey everyone, Eric Freeman here. Today I'm going to talk to you about real estate professionals, why it's important, and how you can make sure to make this work to your advantage when it comes to your tax liability. So first I'm going to talk about the two big categories that are related to this. First, if you're a real estate professional, and then second, if you're really a passive investor. And this is important because by default, as a real estate investor, you're actually treated as having passive income, which means that your deductions related to real estate may be limited. So really, if you can, you want to try and get into this professional category so that you can really get the most bang for your buck when it comes to taxes. So to be a real estate professional, there's really two main things that you have to pay attention to. The first one is the hours. So you have to spend a minimum of 750 hours in a real property trade or business. So if you're doing rental real estate, this would qualify, and this is on an annual basis. The second requirement is that you have to spend more than half your time in a real property trade or business. So this means if you do something else, if you have a full-time job or another part-time job, you really have to know how much time you're spending in both of them to see if you meet this requirement. And it's an annual test. So you may meet it one year, it doesn't necessarily mean you'll meet it the next year. And you want to make sure that you're tracking these hours in case it ever comes into the question, you have something to back up that you actually spent this amount of time. Obviously, if real estate's your full-time job, it's a little easier to justify and you may not need as much support, but just something to keep in mind. So let's dig a little deeper into what the math actually looks like here, because it doesn't seem that hard on the surface, right? I mean, it takes a lot of time to find a property, if you're managing it yourself, doing the financing, all the aspects that are related to it. But the reality is we have to kind of look at it and see if it's actually possible to meet this, especially when you're doing something else. So first, total hours in a year. This is an important number. So there's 8,760 hours in a typical year. And this is just the total hours, 24 hours in a day times 365. So then, well, I hope you're all sleeping. So we'll add in some sleep. So let's figure that you're getting about 8 hours of sleep for 365 days a year. That'd come out to just under 3,000 hours. Then, if you are someone that has a full-time job and you're working 40 hours a week, 52 weeks a year, that means that you're spending 2,080 hours at your full-time job. This leaves you 3,760 hours that you have to spend in real property trades or businesses. Now, of course, the important thing to note here is that this doesn't include your vacation, this doesn't include your downtime, this doesn't include time with family. So really, this is not all hours that you're going to be able to use in a trade or business. But what you want to make sure is that whatever hours out of this, if you have a full-time job, it needs to be greater than 2,080. So you have 3,760 to really spend time trying to figure out how you're going to spend those hours so that you can meet this requirement. Obviously, if you're able to lower your hours here, it makes it a little easier. Okay, so again, why it's important to be a real estate professional is because as a real estate professional, you can actually offset your other income with your real estate losses, and I put losses in quotations because what's often your taxable income is not necessarily your cash flow from real estate, one of the great benefits. So if you're a real estate professional, you have other income, say you have other types of investment income, interest, dividends, maybe you've sold another business, maybe you have wages of some sort, you can use those rental losses to offset that income, and it's a huge benefit. If you're in the passive category though, so you're not a real estate professional, this could mean that you won't be able to deduct those losses in any particular year, because when it comes to the passive category, you can only offset other passive income. If you have positive taxable income from one rental and then you have a loss from another rental, well, then you could take that loss and offset the income over here. But if all you had was this loss and you had a full-time job, you wouldn't be able to deduct that loss from the rental property. So it's really important for planning purposes to know what category you fall under. There is actually a third category that you may be able to fall under, and this is active real estate. This is kind of a compromise between being passive and a real estate professional. And essentially what this means is if you're active in the day-to-day of managing or owning the property, so maybe you screen the tenants yourself, or at least you approve the tenants, you're calling for repairs, and you're really doing some of that day-to-day stuff, or you're managing someone that's doing that. So potentially if you have a property manager, you may still qualify depending on the fact pattern. But the benefit of this is essentially that you can deduct up to $25,000 against your other income. Now there are phase outs and some limitations, but basically you can get a partial deduction here. So if you have more than $25,000 in losses, you may not benefit from all of it, but it's better than nothing. So with that said, it's really important to know which of these three categories you fall under and plan appropriately. Thanks for watching, everyone. If you liked what you saw, go to kenmcelroy.com, visit my advisor page, check out the link there, and you can reach out, provide comments. The link will be below. Thanks again for watching.